Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So today we're in an environment where stock prices are down dramatically, which is a great thing for a long-term value investor. Obviously a terrible thing for what's going on in the world at the moment, but buying and selling shares does not impact the current situation outside of the stock market that's going on at the moment. And like I said, creates a lot of opportunity for the long-term value investor. So one of the topics that I'd heard discussed over the past couple of weeks as stock prices have gone down is whether it's a really good time to start being a dividend investor. So, we're in an environment where your capital gains have turned into capital losses. And, we see the dividend yields going up on certain stocks because the prices are going down. So I want to talk through whether it is a good time to start investing for dividends and what my kind of thoughts are there. I know many of you like to invest for dividends and all those sorts of things, and many of you don't. So let's get into this. Here are my thoughts on dividend investing now that we've gone through a bit of a stock market correction. Okay, so first off, let's just talk through what a dividend is. So a dividend is a cash payment from a company to shareholders, basically. So whenever a company makes money and they've got nothing better to basically do with that cash, they haven't got places to go and put that money in order to expand the business, or they don't want to buy back shares because maybe they look too expensive. They just want to pay that cash out because it's excessive to requirements in their business. They pay that out to shareholders as a dividend. In the States, that typically comes out every quarter. Here in New Zealand and Australia, that typically comes out every 6 months. So it's a cash payment to shareholders with some brokers, depending on who you use to buy and sell shares. You can also set those dividends to automatically be reinvested. So whenever you get a cash payment from a company that you own in the form of a dividend, you can automatically set up that dividend money to be reinvested to purchase more shares. And that way the next year you're going to get a slightly larger dividend, buy slightly more shares, and so on and so on, and it kind of snowballs, and it's a really nice way to set up a bit of a compounding engine with the stock market being your kind of vehicle of choice. So that's what a dividend is. I personally have made some videos in the past on why I'm not a huge fan of dividends, and I think some people can tend to get a bit obsessed with dividend payments, and it's personally not something I actually look all that closely at when I am investing in a company. And the basic reason for that is my goal when investing, I'm not a dividend investor in terms of someone that wants to generate an income from my investments. I am someone who's very interested though in growing my net worth over time by using investment vehicles such as the stock market. So that's my major goal, is to grow my wealth over time. That can certainly be achieved with dividends, but it can also be achieved through capital gains, and often it's achieved through a combination of the two. So if I want to grow my net worth as fast as possible, it makes sense for the companies that I own to grow their intrinsic values as quickly as possible. And the way that a company can grow its intrinsic value is by growing the earning power of its business. And if it can grow the earning power of its business with relatively modest amounts of capital and at a relatively quick clip, then oftentimes we're actually better leaving the money within the company than having it paid out to ourselves. So a really good example of this is a company called Chipotle Mexican Grill, who I'm sure many of the US viewers are very familiar with, and I'm sure that anyone that follows Phil Town is very familiar with this company as well, because he talks about it all the time. And Chipotle have a very good what's called return on invested capital. So I'll put up a number here for return on invested capital and return on equity with Chipotle. It's somewhere in the range of about 20% from memory, which means basically if they can keep that return on equity and return on invested capital relatively constant as they continue to grow, it means that any dollar that they keep within the business and deploy into growing it, whether that's opening new stores or developing new products or whatever it is, any dollar that they invest within the business can produce a return of 20 cents per year, a 20% return per year, which is a phenomenal return. If someone pays the average investor a dividend, there is no way they are going to produce a 20% return on average unless you happen to be Warren Buffett or Charlie Munger or Monis Pabrai, or one of these phenomenal investors which have great track records. So if we can keep money in the business and produce a 20% return, that makes a whole lot more sense than them paying me a dividend and then me trying to invest it at 8 to maybe 15% if I do really, really well, and possibly less than 8% if I make some poor decisions along the way. So for me personally, if a company has a great track record of reinvesting their profits to grow the business, that is definitely the way I want them to approach it. If Chipotle is out there opening up a new store, and with a lot of their stores they can spend money up front opening it, and in certain situations they can have that store paid off in 3 years. So they're getting north of 30% returns on invested capital in certain new stores that they're opening, depending on where that Chipotle store is. So if a company is able to do that, I'm not going to be able to go out and reliably invest in a way where I can make 30% per year. That just isn't going to happen. It'll happen every now and again, depending on the investment, but it's not going to happen consistently. So for Chipotle to have a reliable source of a reliable growth engine where they can continue to plow money, they can continue to open new stores. They're nowhere near the capacity of something like a McDonald's when you've got one on every street corner or anything like that. So they've still got a long runway to open new stores, grow the business, grow the intrinsic value of the business, and have that flow through to much faster rates of capital gain in their stock price, because their business is getting larger and larger, than I would be able to produce had Chipotle not open those stores and then I was investing this other dividend money on the side. And that essentially is my philosophy with dividend investing. If a company can redeploy its profits really effectively, don't give me a cent in dividends, please. If you can redeploy some of that money and then you have nothing better to do, I think if your stock is trading at a reasonable valuation, you should be buying back your own stock. What happens when a company buys in its own shares is those shares are no longer on the market. So if a company has, let's say, 100 shares and you own 10 of them, that means you own 10% of the business. If the business then goes out and buys back 10 shares as well, you now go from owning 1/10 to 1/9, which I think is 11%, 11.11%, I think. So your ownership stake in that business has gone up from 10% to 11% and some change, so about a 10% or so increase in ownership in the business from the company just buying in its own shares. And there's some great things in terms of tax treatment with buybacks versus dividends. So you're not going to have to pay tax like you might on a dividend when the company just buys in its own shares. And if you think about it like, let's say you were in some sort of real estate syndicate, some sort of real estate group where you all owned a whole bunch of properties, and each of those properties was worth, say, $400,000. And if someone in that real estate syndicate wanted to sell out and they were willing to sell all of their stakes in those houses for an equivalent valuation of, say, $350,000, it would make a whole lot of sense for you to buy back those shares, buy back those assets at a discounted price. So same applies when we're in the stock market. If the shares are trading at a relatively cheap valuation, I think firstly, we still want to invest in the business where possible, but second, we want to buy back shares when possible as well. I am a big fan of that. I think it can be done poorly and done at high prices, which unfortunately we've seen a lot of recently. But if it's done at really cheap prices and you're genuinely buying something for less than it's worth, that's a great call. So that's kind of the second one in my checklist. And beyond that, if you can't grow the business, if you can't buy back shares at a reasonable valuation, basically all that's left is dividends. Assuming that you haven't got bucket loads of debt or anything that you need to pay off as well, a dividend payment is the third option. So if we get to that kind of threshold, more than happy to collect a dividend and start funneling that money elsewhere and those sorts of things. So those are my thoughts on dividends, and the rules don't really change based on stock prices. So if stock prices are high or if stock prices are low, the same principles apply, and that's kind of the way I think about dividend investing in general. So it's not something I focus on very strongly at all. I focus on what's the intrinsic value of the business versus what it's currently trading at? Can I buy it at a discount? And when the company makes profits, that's kind of the few thresholds and checks that I like to hope that the management is thinking through as well. Now, with all that said, there are a lot of investors out there who are not, who do not have the same goals as me in terms of growing net worth over time. There are plenty of investors out there who want to live off their stock market investments and live off dividend income. So for those people, there are some general kind of metrics that a lot of people look at and that I would look at as well if my focus was to set up an income portfolio as opposed to something where I want to have it grow substantially over time. And all of these stats are relatively easily available on tools like Yahoo Finance. So the first one is simply a dividend yield. So this is based on the current price. What return per year are you getting from simple cash payments and dividends? And the great thing when we've got falling stock prices like we have at the moment is assuming that the business is unaffected, and that is a big caveat to what I'm about to say, assuming that the business is unaffected, if the dividend payment stays the same and the stock price drops, say 50%, that means the dividend yield doubles. So if previously you had a business that was paying a 2% dividend, and it continues to maintain that same number of dollars that are paid out as dividends over the next, say, 12 months. But in the meantime, the stock price comes down 50% and you can buy it for half of what you had to before, then your dividend yield has now gone from 2% to 4%. So it's doubled your dividend yield. And that is a great advantage of being a dividend investor right now, as prices are coming down and dividend yields on the whole are actually going up. So the couple of things to watch out for is dividend yields don't have to stay the same. They can be cut. We're seeing this with a business like Air New Zealand, which many of you will know quite well at the moment. They have basically just had a line of credit from the government to help bail them out because they are in a strong downhill slide with their business at the moment and everything that's going on out there that is restricting travel. So they recently had up to $900 million made available to them by the New Zealand government, and they're in a situation where they've said they will not pay a cent in dividends until that loan is paid off. And this is from a company that a couple of weeks ago I think was at something like about a 10% dividend yield. So very high dividend yield because they'd had a relatively good last 12 months. The price had also come down a little bit, pushing that dividend yield as a percentage up. But now that dividend yield has been cut to zero. So there's certainly some things out there you've got to watch out for. You still have to really understand the business and know what you could potentially threaten that earnings that they're producing and the dividend that they intend to pay. So that's the first thing. If you are in a relatively consistent business that is largely unaffected by what's going on right now, there's some other things you can also look at. So the first thing is the payout ratio. This is simply what percentage of their profits are being paid out as dividends. So if a company, let's say, makes $1 million a year and they pay out $500,000 a year to shareholders as a dividend, that's a 50% payout ratio. So ideally, the lower the payout ratio, the better. That means they have more room to boost that dividend over time if they find less and less, like I say, opportunities to invest in the business and buy back shares and all those sorts of things. So dividend yield, payout ratio. One I want to add, which I often don't hear dividend investors talking about enough, I don't think, is levels of debt. So this is a big one. We saw an extreme example with a company like General Motors in the first part of the 2000s. So General Motors went bankrupt, as many of you know. And one of the reasons for that is they had this long history of paying consistent dividends every single year. And when we were in the early 2000s, we got to the situation where General Motors had this enormous history of paying dividends. They had a lot of shareholders that were retirees and people that really needed and relied on that dividend income. And they chose to keep paying it no matter what. And in this case, no matter what means the business wasn't making enough money to basically pay the rates of dividends that they were wanting to. So they went out and borrowed money. They borrowed money to pay dividends and, you know, in the hopes that the business would improve and that eventually would be able to pay down that debt and and fund these dividend payments just with their own business. But unfortunately, that never happened. We had a recession in 2007, 2008. The company went bankrupt and the shareholders went to zero. So that is one thing I would certainly watch out for. Often you'll see things like that with a really high payout ratio. So if a payout ratio is over 100%, that means they are paying out more than their entire year's earnings in dividends. And they're probably taking on debt again to fund that. So certainly something to watch out for, but debt levels is probably one I don't hear talked about enough. So those are my thoughts on dividends and dividend investing. It is, we're in the land of cheaper stock prices than we have had in the last year or two right now. So dividend yields are up for companies that are able to maintain their earnings. And that's a great thing for the dividend investor looking for those income opportunities. So for me personally, it's not a huge focus, but I know for many of you it is. So those are my thoughts. So I hope you enjoyed the video. If you did, be sure to hit like and subscribe. You can watch some older videos over there. Hit subscribe over there. Thanks for watching. I will see you in the next one, and stay safe out there. Cheers.